Alright folks, so in today's lecture we're going to be talking about AMD. So what is AMD? So basically AMD stands for Accumulation, Manipulation and Distribution. It's a program that runs within the algorithm to manipulate and engineer liquidity. It's designed with human emotion within its logic, and the program consists of a three-phase cycle. So what you have to understand when you're thinking about the algorithm is that when it was designed, the whole point of it is to manipulate human behavior to entice buyers or sellers into the marketplace, because essentially they want to steal our money. And one of the macros that they run within the algorithm itself is this pattern that we see, and ICT is dubbed as the AMD pattern. Let me go into a little bit more detail with each phase. So accumulation. Essentially, we start with a consolidation, and the reason for this is that we build buy stops above the market and sell stops below the market. When the algorithm goes into this spooling cycle, it stays within this range. So we have like these periods of consolidation, and essentially it's engineering liquidity above and below the market. Our next phase is the manipulation phase. So the sell stops, which were below the consolidation, are now triggered as market orders. Smart money then pairs these sell stops with long positions. We have our expansion phase down. Then the market reverses and we have our expansion phase higher, triggering the buy stops. And then obviously these become market orders. So this whole cycle is to, number one, engineer liquidity by holding the market within a range. We build stops above and below the market. We then trigger the stops on one side. This is our manipulation phase. And then the market reverses and moves higher, and this is known our distribution phase. So essentially it's the market efficiency paradigm, where we're taking sell stops and we're offloading those long positions paired with the sell stops above buy stops resting above the market. So let's go into a little bit more detail. Again, we're going to be using a bullish market profile. You can reverse this for a bearish market profile, but again, just to save time. So if we have a level in mind, which we deem as our draw on liquidity, usually we're looking for fair value gaps and old highs that are situated above the market. So the market has moved higher and we've been held in this consolidated range just below this draw on liquidity. Now, when we see this, the market again is engineering liquidity. We have our manipulation phase downwards. But how far will that manipulation phase go and what can we expect? Well, we don't want to just take an entry because we've seen a consolidation break to the downside. Breakout traders will look for the retest below the consolidation breakout. But what we want to do is we understand that there's smart money is going to be pairing orders because we haven't hit our draw on liquidity and we are in an underlyingly bullish market. So when the market breaks down like this, we're looking on the left hand side like we always do, and we're looking for our PD arrays in our discount market. So your fair value gaps, your order blocks, your breakers, your mitigation blocks and your old highs. We want to pair the left side beneath the stops with our manipulation leg, and essentially the market will reverse and offload those long positions to willing buyers above the old highs or the fair value gap. What we need to understand about the AMD pattern is this is fractal. It can work on any time frame, and it's a repeating phenomenon that we'll see in the market over and over and over again. The algorithm is very limited in what it can do. There's only a certain number of ways it can engineer liquidity, and this is one of the main ways it would do it. Now, to take this into a little bit more detail, we can combine the AMD pattern with the power of 3 pattern. And again, the power of 3 pattern can work on any time frame. It is basically the range within a candle. So say we're looking at the daily range. Now we have our 12 a.m. candle, and just prior to the 12 a.m. candle we've had our accumulation. Then we have our manipulation phase to the downside into one of these levels. We then move higher. We can also use our 8:30 opening price, and we're waiting for the market to move lower into, remember, one of our levels. But hold on a minute, this doesn't look like it's accumulating anything. It looks like it's just retracing downwards. Price is fractal, so if we take this area and we go to a lower time frame, say for example this is the 5 or 15 minute chart, and we want to go into the 5 or the 1 minute chart, we will see the same pattern. So we'll have our accumulation phase, our manipulation phase into a level, and then our distribution phase higher. On a typical buy day, we can see the market consolidate before 8:30 a.m. and then we'll have our manipulation leg lower into a level. I think the main takeaway here is when we are hunting setups, we are waiting for areas of liquidity to be taken, and we're looking for that expansion leg or the manipulation phase going in to one of our arrays. So whether it's in a premium market or a discount market, we're looking for this signature where liquidity is taken into a fair value gap or an order block or a breaker. Not one of them is better than another. You're going to have to obviously look at what the market and price is presenting you with at the time when you're in front of the charts. You might not have all of these here, you may have one of them or two of them, but the probabilities are increased if you're pairing liquidity with one of these levels. You're using power of 3, you're using the AMD cycles, and you can look at the fractal nature of price. It could be on a daily chart, you can see these form. What I tend to use, and this is a little hint, is I use the power of 3 on the weekly time frame. So that weekly candle, I'm also looking at that weekly candle as the power of 3. And I'll leave that one for your studies. So let's go into a chart. This is the S&P 500. We have our 12 a.m. candle delineated over here with this red line. We have our consolidation area. So we have buy stops that are resting above it and sell stops that are resting below it. So the market is in the accumulation phase. We then have our manipulation leg down, triggering the sell stops as market orders. But does it come into just any old level? We have our fair value gap over here, and sell side liquidity resting below these lows and these lows as well. Price reacts and we move higher into, well, this was a daily high. I should have probably annotated this earlier, but this was our draw on liquidity. If we look again closer, we have a consolidation area. We have our manipulation leg into where? Taking out sell side liquidity, triggering the stops, and into an order block. So we have our order block, fair value gap, sell side liquidity, optimal trade entry. This is high probability. And then we move higher. So I hope you found this one insightful. I'll be building on these concepts, and there'll be future videos coming out that will go into a little bit more detail, and I'll be using real life trade examples so that you can see how it works in practice.